Good day, fellow investors! Start of the month, 9 stocks to buy for February 2025. To get our stocks to buy, we go to our value investing quadrant. So we have the reward on the x-axis, low reward towards high reward, and we have risk on the y-axis, low risk and high reward. You want your buy to be here, which is then the best low risk, high reward investment. This is what we'll discuss today. We'll go through the key companies that are a buy according to our cutoff of risk and reward, and we'll also use our intrinsic value template to show what's going on, what is the intrinsic value compared to the stock price and the likely long-term returns. Smash that like button if you like this, and let's immediately start with the buy here, Warren Buffett's top buy for his portfolio over the last year, and that is the US 3-month Treasury. The yield is down from above 5%. That's related to what the Fed is doing. I'm filming this Wednesday morning before the Fed lowers rates or holds them still, but you still get 4.3%, 3% inflation, 1% real return. If you don't have anything better, this is the no risk, some reward. I wait for other opportunities to hit my buy level. Perhaps you'll see in the next 8 that we'll discuss, but if Warren Buffett is doing, I don't see anything wrong. Yes, stocks always go up until those don't. So we have here Warren Buffett, and I think this tells you more than everything else, 220 billion in short-term US treasuries. So that's value investing, no risk, not investing on hope, not gambling, just certainty and safety. And then you have to ask yourself, how does it fit your goals? Let's say you have a 10 million portfolio. Is it okay if that portfolio goes to 5 million in a stock market crash? If it is yes, you just invest for the long term, doesn't matter, stocks will get up again, then okay, be your guest and buy the S&P 500. Also, ask yourself, am I happy with the 1.3% dividend of the S&P 500 growing at 5%? Okay, but maybe 4% for sure is better. That is the risk and reward. Only you can know how it fits you. Let's go forward. Berkshire, we'll discuss it also tomorrow in the margin of safety video, and here is a sneak peek of it. So the book value is a little bit lower than the current market value. The value to private owner is close to the current market valuation, but I think that it is on the expensive side now because historically the P ratio goes from 10 to 25 for Berkshire, and we are now at 25. But with the cash there and with the compounding, with a very strong long-term perspective, being a financial fortress, being everything, I would put here Berkshire on a very low risk that it will deliver over the next 10 years, but maybe the return will be between 0 and 5% real returns with some inflation, likely positive returns, better than the S&P 500 for sure, certain, and therefore I put it here as a low risk, let's say medium return going forward, 5, 6, 7%. Nothing wrong with it. What else do I have here? Let's go to Nike. Now, my problem with Nike is that it isn't as cheap as it could get for what it offers. If we look at the dividend and the potential growth rate going forward, it all depends on the terminal multiple. If the market is happy with a 3%, now it's happy with a 2% dividend. If the market needs a 3% dividend because Nike's innovation doesn't deliver, then the intrinsic value is even lower, and that's why I think I consider it risky for a 10% return. Likely 5% return dividend, but if the market requires more from Nike, then it can get very, very ugly. So I'll put Nike a little bit lower here, below the buy threshold, because it's simply a little bit too risky. Kraft Heinz, we just discussed it recently in a video, and here you can see that the yield is already much higher. Check the video. All the links to the videos mentioned will be in the description below, also in the intrinsic value. You can click there and it leads you directly to the research. But 5.5% is already way higher than 2.5%, and therefore you here see how if just 3% growth, 5% good yield over time, and you can see that it can lead to a 10% required return. So yes, these brands now are in a little bit of a pickle, high competition, a little bit of struggling compared to the great years they had the last decade, but the dividend is there, which is always something that gives you more certainty over time. Next, we have Schwab here, the dividend ETF that we have discussed, and here I'm making a small change because I have had it as a 10% return, but then I figured that I have used a 7% dividend growth rate since the ETF was launched in 2015. But there was not really a proper recession there calculated that would hit the dividend stocks. So I have put a lower rate there, and therefore I think with the dividend of 3.5%, with 3-4% growth, 7% return, the intrinsic value is likely to be better, not at 28, but at 20 for a long-term return. So I have pulled it a little bit back in line, let's say, with the market there and below the risk and reward buy threshold. Another stock, DHL, that we have discussed, dividend yield is already higher. They are also doing buybacks that should grow the dividend yield per share even if there is stagnation. So if we look at the intrinsic value template with a 4% growth rate, with a terminal multiple of 20 that gives you a 5% dividend yield, the intrinsic value is close there to the stock price. So now we look at a 9% return. If the market gets exuberant, then the stock price might go higher, and that is also a possible return, but also downside there if things get ugly in Europe. That's the risk and reward. So we have DHL here, let's say medium risk, medium reward, market risk, with a little bit better reward because of the good dividend and good buybacks. The guidance there is for 3 billion of cash flows going forward. If they keep on growing over the long term, that is then a good return. Let's see what is going on here with Exxon. The current dividend yield is 3.67%, and to me that's too high. The yield should be 7. For a company like Exxon, especially in a baby drill environment where oil prices go lower. I have seen Exxon trading at 7% yield, at 10% yield, and now at 3%, which is simply too exuberant. So if I put a 5% yield, then the intrinsic value of the stock is 72, which compared then to the stock price gives me a lower required price for a 10% return. Of course, if you're happy with 5, 6, 7%, but I don't think that oil cyclicality is good for a 3% return. So therefore I have increased the risk here and lowered the reward because of the baby drill scenario. JD, PEETS, the coffee, now coffee prices are higher, the stock is down, and we are already discussing something different here. We have discussed the new analysis, made the video 2 days ago, and if we look at the dividend there, earnings per share, payout ratio 65%, if they keep on the dividend, if I go to a terminal multiple of 15 on the earnings, the value is close again to the stock price. That's another interesting solution for a 9% return. If there is a boom, it will go to 25, and you can also trade on those cycles. Check the video for more information. Next, we have here Samsung Electronics that we have discussed. Verizon is another company that we recently discussed. But let's go on to Samsung. The company is traded in London, 25 shares represented in US dollars. If we go to Samsung Electronics. I'm filming this on Wednesday, earnings are on Friday, so maybe some things will change, but for now, if we go to Goldman Sachs report, here you have the forecast for earnings. This is for this year and then going better, and if you compare it to the stock price, you see that the P ratio is going to single digits and the price to book is going below 1. The dividend yield is going higher. Thus, their target is for a return higher, growing. So I have put here, this is in US dollars, payout ratio of 35% compared to the London stock price. And you can see here that also Samsung now is giving a 10% return. If there is a different view on Asian stocks, and this is a global stock, then it might get re-rated and you have yourself a good return there, perhaps even a 3x over the next decades with the terminal value going 3 times up in a positive environment. If you look at the stock price, you see we are now in the downturn, but there is this Samsung cycle that usually is in line, and Goldman Sachs also has it with a strong buy target. The risk and reward, here is what they say. So very cheap risk, memory, supply and demand deterioration on the semi-cycle, smartphone margins, OLED market share, loss, but that is the risk and reward in line with the market for a good return of 10% on a P ratio of 10. Let's continue on our table. I have added RUBIS here, the oil distribution company in the Caribbean and Africa. And if you go to the template, you can click here. I have added the dividend here of 2 euros per share. If they grow with just 3%, there is some value in some renewables that can be unlocked. But if they keep on paying 8-9% dividend yield, then the intrinsic value is now still higher than the stock price. Here, you have to keep in mind now the French taxes, which I think are 25%. So if you want to calculate, to implement taxes in your distribution, in your intrinsic value, you can write 75 here. If there is a 10% taxes, you write 90 here on the dividend. And then you see how that compares and how that changes your intrinsic value that you then compare to the stock price and also in the comparative table here for buys or not. But taxes are individual and you have to always see how that fits you. So that is something you have to individually change there. That is the key here. All the rest depends on oil prices, but there is, let's say, also a margin of safety in the dividend yield and the business ownership they have. Another business that we discussed is Archer Daniel Midland's. So again, another dividend, 4% growth, food inflation. The market is happy with the 4% dividend. For a margin of safety needs to go to 20, and then maybe they will still grow at 4. Then you need it a little bit lower than the current stock price of 50. The riskiest with the highest reward here is Petrobras, Petrolelo Brasileiro. Dividend yield likely to be 13%, stock didn't change mind, but lower oil prices would put this likely under pressure, and that is why we have it here as a risk. Now, these are the 9 stocks, but there is also a strategy. You have to see how does this fit your portfolio, and there was a good comment asking how to allocate money to each of these positions, and I'll talk that into a video next week specifically on portfolio allocation and how I do that. I'll see you in the next video.